Hello again, everyone. Welcome back. Thanks for tuning in this week. Now, it's been a while since I've touched on the overall market and how far it will decline and how long it will take. It's kind of been taking a slow grind down right now. We haven't seen anything major with the economy happen. We had some tariffs earlier in this year, but nothing major when it comes to unemployment or any big shocks to the system. But I've got some historical data I'm going to look at, and it's been a while since I've done this. So I've analyzed this data in depth. Are we going to see 5, 10, 15, 20, 30% decline from here on out? So stay tuned because I'm going to analyze these numbers in depth and find out what may happen in the coming years. So first up on this week's highlights from Daniel Foch, completed unsold condo units hit a record high in Q2. GTHA completed an unsold new condo apartment. So that's Greater Toronto and Hamilton area. It's a lot of places included in here. And look at that, going back to 2005. And the biggest or the most amount of inventory we had since today would have been just over 1,500 units back in 2014, 2015. And look at today, 2,500 units on its way to 3,000, going straight up. This isn't stopping anytime soon. Developers cannot sell these dog crate condos and these overpriced, I guess, dog crate condos. And they're going to be left holding them because speculators and investors are no longer buying these. It's end users left, and they don't want this type of inventory. All right, here we have housing experts in 2022. We have Aquaman, all fit and whatever. And this year, 2025, well, this is the housing experts now. And this is pretty accurate if you ask me. From a wise, once used to be realtor. She was in the business for a while. She lived or worked through these times. And this is what she has to say. Donna Backer. In 1989, it appeared that the days of buying a house for under $100,000 in Hamilton's were history. By the mid-90s, less desirables of the city had been repriced back down to $50,000. In 2021, nothing was under $500K. Now I'm seeing $300K. Location matters. And this is true. I just posted about this, and check out what I said. Just put this out last week. In Niagara, we had 8 detached homes sell for under $300K in July. The lowest price was $225,000 for a detached 3-bedroom bungalow on a 113 by 98-foot lot in need of major repairs, obviously. I have many people tell me we won't be able to buy a home under $500K soon. I've had this told to me many times this year. And we're seeing places under $300K. We regularly sell places under $500K in the region. Like, it's very common. All right, from Darth Powell, he's from the US, but this is very relevant to Canada. We have the same type of population dynamics when it comes to the amount of boomers. Between 13.1 million and 14.6 million boomers are projected to exit home ownership between 2026 and 2036, sparking concern in the housing industry that such a surge in inventory could trigger a price collapse. Berkshire Hathaway Home Services have supposedly said this, and I see it all the time. I sell many homes that are estate sales and power of attorneys. We are seeing that population aging. They can no longer stay in their homes, whether they have to go for secondary care or for to the grave, unfortunately. But we're seeing it. I've sold a couple already this year, and I see them all the time. I show them all the time. Estate sales are one of my favorite kind, and you've probably heard me say this before on this channel, but I love selling estate sales. They're in great areas, well-maintained. They're dated, so you usually get a bit of a deal on them too. And from Tim Houston, I believe he's the premier of Nova Scotia. More housing, more affordability, more momentum. We're building 29 new affordable homes in Port Hawkesbury and Arichat, giving more families a safe, stable place to call home. Since 2023, our plan has paved the way for over 51,000 new housing units across Nova Scotia, and we're just getting started. So here's their affordable housing here. Reminds me of those places outside of a school there, the portables, I believe they're called. And here they are, a little one room. Maybe it's got a bedroom or a bathroom. So 2-room maybe, looks like. Garden sheds. So here's the hierarchy of housing. It starts off with homeless, then you get to a tent, then you get to a garden shed, and then you have these. That's how they fit in. I don't even have to click on this one. It's better if I don't. You can see it better. Canada's household debt to GDP, 103%. Canada tops the global leaderboard for household debt relative to GDP, higher than the US, UK, and even debt-sensitive economies like South Korea and Australia. This ratio means households owe more than the entire annual output of the country. And there you have Canada, household debt, a share of GDP, 103%. Next in line is UK, and that's 23% less at 80%. Canada is a debt slave. It's a debt nation. It's crazy. It's like our whole economy is run on debt at this point. And last up, before we get into this week's exciting data, we have from Market Mania there, my buddy Luke. I think he made this chart or marked this chart up from the Fed in the US. But yeah, here it is. 8 years. So this is the declines of our housing bubbles or our housing corrections or booms and busts here. 8 years from 1976 to 1984, minus 22%. 9 years from 89 to 98, minus 21%. 1 year from 08 to 09, we got off easy, of course. Canada did in that global financial crisis, minus 10%. Now we're at 23.5%. We're not all done yet. And it's 2022 to who knows when to 2025 right now. And we have seen the biggest decline or biggest housing correction when you're looking at this index from the Fed in history since 1971. Anyway, let's take this chart and analyze it ourselves to see where it goes. Okay, so here we are. Here's the same chart. And you know what's kind of sad is the US has better housing data, historical housing data on our national prices than Canada does. Canada goes back to 2005, and I have that data in here also because I'm using this to reference for the future. But yeah, the US goes back to 1971. This is inflation-adjusted data, and this is an index, so this is not average prices. This is based on an index, and Canada has an index also. It's called the HPI Benchmark Index, or the MLS HPI Benchmark. But yeah, so this is from the Fed in the States. So yeah, let's get into this data here, and let's start out comparing it to the Canadian data. So Canadian data, again, goes back to 2005. We don't have a lot of national data, and I know MLS just was created, but still, like the Stats Can or somebody, they don't have this data, and we have to go to the States for it, which is crazy. So here's the average price in Canada, and this is based on nominal figures, like figures right now, what you would pay in cash for a house. And here is the Canadian benchmark, the MLS HPI benchmark aggregate price or the aggregate composite. And if you look at the peak there, it goes to about 840 or so. And right now we're sitting just under 700, 690, 700 on that benchmark. And the average price I know from the top of my head, it was 815 was the peak pricing. Right now we're at 691. So we're very similar with today's pricing, but the peak was different. So the HPI was higher than the average price. Now let's just see how it looks like they line up the trends, right? You see the dip back there in 2010 on the left side of the screen, and you see the peak matching up. So very representative. Of course, we're going to have to play with the numbers, but they are very representative of these charts with the peaks and the valleys here. Okay, so I filled in some numbers. Their base year is 2010. It says right on the left-hand side there, their 100 index is in 2010, and we were at $335,000, which would be the real and the nominal price for this chart. So everything's going to be based off of that, and we're going to work with the index and, of course, these real inflation-adjusted prices going forward. The black is the nominal prices based off of the real prices. So, and I used the Bank of Canada to get the black numbers there. Now, looking at the black numbers, the peak, our benchmark, our HPI benchmark, if I go back here, you can see it right there. It was 840. So it looks like there's about 40,000 or so. I'll give it 35 to 40,000 over what the real HPI index was. And same with the one that's right now for 730,000 there. We're at 691. So that's 39,000 over what the realistic benchmark price is right now. So let's just keep that in the back of our minds. We're going to have to adjust these numbers later down about 35 to 40,000 to adjust for this discrepancy. So let's move on here. So here we have the increases and the decreases in these peaks and valleys. Back starting from 1971 there, it was up 45% over 6 years, the prices increased, and then they lost 20.5% over 8 years. The next cycle in the 80s there was up 65% over 5 years, and then it dropped 21% over 9 years. So these are big long terms, right? A lot of people think it's a 5-year, 6-year like the US was in 08, in the 08 crisis to get to the bottom. But no, it's a lot longer in Canada, it seems, until you get to 2010 or to the 2000s to the 2010 there or so. And it was 10 years, it went up 75%, the house prices. And of course, only 1 year it took to drop 10%. Now you can see my numbers are very similar to what Luke's are on his chart, 20, less than 23%, and you get up to 23 now in our current times. Anyway, moving on, 122% from 2010 up to 2022. I think it was actually 2009. It's about 13 years there. And it was 122% prices increase. That's 190% in nominal terms, which is huge, right? And then we've only been 3 years right now, and we've lost 23% or 17% in nominal terms. And if you look at the Canadian average prices, we're down about 15 point something percent right now from the peak to now, and that's his average prices, not using the benchmark. So this is it's not far off this data. So I'm pretty happy with the accuracy of it, and it's something that we can use here to forecast going forward. Now we're going to look at how much of that gain did we lose. So we run up, and how much of that gain did we lose in these housing corrections in these times where prices went down? And yeah, the first one there, we lost 65% of the gain. And that's a lot of gain to lose. And this is just the gain, not of the house prices from zero to whatever it was. This is just the gain. And the next one after that, there in the 80s into the 90s, we lost 53% of that gain. And in 2010 or 2009, 2010, we lost 23% of the gain, which doesn't look like a lot there, but 23% of the gain, not bad. But house prices came down 10% in total, but that was 23% of the gain. Then we have the big run up. Look at the run up there. Again, a 13-year run up. We've already lost 42% of that gain to the peak. Now, I was looking at these numbers, and I look at Fibonacci. And if you've watched this channel way back, I did like the Fibonacci levels on this. So I'm going to use these now because it is a great indicator of levels that we're going to see. And you'll see a trend here. I believe this guy was some old Italian mathematician. Maybe he wasn't old, but and he came up with this. And a lot of people use this, and it makes sense. And you'll see how it plays in here. And this is how we're going to kind of zone in on percentages and where things could go in the future. And so here we have back in the 70s there, the first block of numbers. And look at that level there. And we actually hit it in, 83 or so, 61.8. That's a major level in the Fibonacci retracements. And we actually hit it, and a year or so later, 2 years later, we actually dropped below it. But we did hit that. And look, when we hit it, we stayed at it for a while. So it did test that major level. And of course, the support couldn't hold, and it fell further. Now we're going to move on to the 80s into the 90s there. And look at that, 50%. We actually hit that 50%. Again, one of the major levels in the Fibonacci, the 50% retracement level. And we dropped a little bit after that. We dropped a little bit further. So again, but we did hit and have some support there at that 50% retracement level. Now we're into the 2008 financial crisis here. And I think I had 23% before. I probably rounded it off. It might have been a little bit higher than 23%. But again, that 23.6% is the first level on the Fibonacci. And bam, we hit it like dead on. That was it. It was 23.6%, close to it. And of course, it recovered after that. And now this is our current trend, or our current cycle we're in right now. And again, it started in 2009, this cycle, after we recovered after the 2008 financial crisis, which we got off super easy. It didn't really affect us at all. And we've gone past that major level of 38.2%. We're down to 42%. So we're in between right now. So we're either going to come back up and hit that, which I don't think we will, or keep going. And let's again keep going here. So if we were to hit 50%, if we were to hit that 50% retracement level, it's not that much lower. We're at 42% right now. Actually, I think it's 42.2. I rounded it off. And here's the numbers. Real prices based on those 2010 base year is $486,000. The nominal price based off an index from that, again, this is an index from that year, nominal price using the Bank of Canada inflation calculator would put us at $688,000. And then you were going to adjust it for the average prices because, of course, the benchmark prices and the indexes are higher usually. So we're down to $653,000, 5.4% decline from our current prices of $290,000 or so. Now, we see that in the winter, right? We see $660,000 in the winter. So To say that, prices are only going to decline 5.4% more, I think that's pretty ludicrous. They're going to go more than that. And this is a seasonal decline. So a seasonal decline will put us at that 50% retracement. So what's next? The 61.8% retracement there. There it is, 61.8. When we hit that, we will be at, there's the real numbers, 443 in 2010 terms, nominal price of 625. And again, those are benchmark, but when you adjust those to average prices, non-benchmark prices, 590,000, 14.5%, almost 15% decline in house prices. Now that's nothing. Like that's easy. I say we keep going here. Let's go to the next level here. I think it's a 78.6 or something here, but 15%. I'd say that's a given at this point. And it could take years. Could take a year, could take 2 years, could take 5 years. Look at those cycles. We've only been 3 years, and those big cycles were 8 to 9 years in Canada in the 70s and 80s. All right, let's keep going here. One last one, the 78.6% retracement on the Fibonacci here. Let's see what it is here. 381,000. Now remember, it was the real prices in 2010 were 335,000. So I would say that that's very possible. The nominal price, 539,000 on the index, and that would bring us down to about $505,000 for the average price in Canada. Now, at that average price, that would still be over 5 times average household income after tax. People, they're making a lot more money. Of course, they are. Prices have gone up or wages have gone up. But that's still like after tax, like the average family doesn't even make 100 grand, but maybe in a few years they will. But that's still 5x the average income, still overvalued for housing. So that seems low here. It's a 30.5% drop from our current prices, and that would be like a 45% drop from the peak, right? So again, not unheard of. This is not insane. Like you can't look at this and go, this is insane. This will never happen. Like this can happen. In the 70s and the 80s and the 90s, we went 55 to 65% where the drops, or 53 to 65% where the drops. So this is, of course, more, but we had the biggest run up. We had a way bigger run up than ever. But I think it would be safe to say, just off of the Fibonacci alone, like a 15 to 20% is most likely going to happen. It could take years, could take a year, could take 2 years, but it's going to happen. 15 to 20%. That's nothing. That's like 5% of it's seasonal. And then you have another, 15 or 10 to 15% after that. And we haven't even hit an economic crisis yet in Canada. So yeah, watch out. All right, one last metric here, the mean line. So it's been a while since I've done the mean line, the reversion to the mean line, the reverting to the mean line, whatever it's called. And you'll see right now, the mean line, real prices, again, I'm using this historical data. Now, before when I used the mean line, I only could go back to 2005. So the mean line was a lot steeper. Now I can go back, to 1971 and see how far, or that trajectory on that line. And I've given it a good trajectory up here. But 370,000. Nominal price, 525. Let's see what that is in 2027. So I've gone a little bit further out to 2027, 402,575 in nominal terms. Again, using a benchmark or index pricing here. And here we have adjusted for the normal or the average price of 540. This is just for the nominal average prices that you'd see on CREA that they report on. So 540,000, what's that for a decline there? 22% decline from our current price points right now. So again, not unheard of. And of course, this is just hitting that mean line. What if it dips below 30% easy, right? So 20 to 30% we could see. And I think we'll see 15 to 20% any day. Will we see 30? I don't know. And the reason I'm skeptical on it is because what the government wants to do, in my opinion, is they want to inflate their way out of this crisis, out of this housing crisis. So we're going to see these prices that will trickle down, but wages will come up and inflation will help inflate these prices away. And just like they do with debt, they'll inflate your debt away. So, we might not see the 30% because it could take that long to get to it, but it depends on how quick things happen. But again, 15 to 20%, maybe 30%. It could be even worse. It could be 40% from here, but that's a big crash from the peak. That's over 50%. But again, not unheard of. So let me know what you think. Do you think 10, 20% is reasonable, foreseeable in the near future? Or do you think it's going to be a 30, 40% decline in house prices over the next however many years? Let me know also how many years you think it will be. Do you think things are going to happen quick, slow trickle down, or will something happen in the economy in Canada and people will just run for the hills and you'll see a big decrease in a short amount of time? Anyway, that's it for this week. Thanks for watching.